Makes sense. What I want to do, example 5 is a little bit similar and a little bit easier. So we're going to go to page 8 and example 5. So all of these have to do with when we can recognize revenue, what do we do if we have possible refunds, things like that. Okay? So on example 5, we've got a right to return example. And I'm just going to autofocus this. Okay, Sandhill Growth Company is presently testing a number of new agricultural seeds that have been recently harvested. Now, like many businesses, to stimulate interest, it's going to grant 5 of its largest customers the unconditional right to return these products if not fully satisfied. And it's going to extend for 4 months, so that's significant. Sandhill sells these seeds on account for $1.7 million and they cost $600,000, and they sell it on April 2nd, 2020. Customers are required to pay the full amount by June 15th. Now, one customer who purchased $110,000 of seeds returns all the seeds on June 1st, 2020. So the company follows IFRS. We want the journal entry for Sandhill Growth at April 2nd, so when they sold the goods, assuming estimate returns of 20%, and June 1st is the other entry. So let the entries and try and piece them together. Let me summarize what we're going to do first. We are going to set up a refund liability separate from the sales revenue. And it will be used for returns. Okay, and I'll explain it as we go along why. So April 2nd is the sale. So, are we getting cash right now? No, they don't have to pay till June 15th. So what are we going to have? A receivable. Now, how much did they sell? $1.7 million. Okay, so that's given. Normally, we'd put credit sales revenue, right? And that would be it. However, there's a big chance, and in fact, they estimated at 20% that customers are going to return the seed for a full refund. So, we can't put sales revenue at 100%. It's different if there's, a 0.5 chance or something like that. Then we'd be safe putting that. And again, that would be a matter of your judgment, how material the amount is, things like that. Generally in our questions, they tell you there's going to be 20% of returns. You're looking at, well, we better separate it out then. Okay? So, sales revenue, what percent? Well, let's do the refund first. So let's put a credit to, it's called refund liability. So this is new. And it's going to hold the value of everything that could be returned. So in this case, how much can be returned? Or do they estimate? 20% of the sales. So that would be $340,000. That means the sales revenue we can record right now is going to be 80, or the rest, however you want to do it. And so the difference there is $1.36 million. Okay, so you need to notice there's a split. Some is revenue, some of it isn't. Okay. Now, our inventory also left, but some of it might be returned. So we're kind of doing a matching entry for inventory or cost of goods sold. And we're kind of gonna match I guess I could say cost of goods sold to sales amount. Okay? The rest goes into a separate estimated inventory return account. So, we're going to leave some room for some debits. We're going to go down to credits. So, what's leaving our warehouse? Our seed inventory. And how much left? 600,000. So, just as we can't record all of this as revenue, we're not going to record all of cost of goods sold as an expense. This full amount is not going to be an expense. It's kind of going to match sales and what percent of sales did we get to record? Well, 80%. So we're going to take 80% times 600,000, which gives us 480,000. Now the rest of that is called estimated inventory, returns. And it's going to be the other 20%. So 20% times 600,000, and that equals 120. So this little guy, our estimated inventory returns account, which is part of inventory, is a separate account for transparency. And what's the word? You have to check for impairment. Okay, so this is a little kind of odd. We're trying to match cost of goods sold to the same kind of amount. We're talking 80%, okay? If only 80% technically is cost of goods sold, then we must not have sold the others, so we think of this as still being in inventory, okay? Now, let's see what happens on June 1st. He returns, or the customer returns some stuff. So, now let's look at June 1st. Kind of squish it. Is the return. So, they returned $110,000 worth of stuff. Have they paid us yet? No, returns the seeds on 1st, and he doesn't have to pay till June 15th. So, we're going to debit refund liability. Have this set up for a very specific purpose. and that's for returns. So we're going to debit refund liability for $110,000. What are we going to credit then? Well, AR is going down, and that's also for $110,000. Okay, so we kind of look backwards in time. If we knew they were going to return those seeds, right, let's say the next day, this wouldn't go up, this wouldn't go up as much. They'd both be lower. Okay? Now, that takes care of the AR, kind of the customer. Now we need to look at our inventory. What happens with our inventory? So what happens to our inventory? Well, it comes back, a debit or credit. It's a debit. Seed inventory. Now, if not damaged, put it back in inventory. Now, this estimated returns, should it have been here? Let's think again. If we knew back here they were going to stuff the next day, would we have the seed inventory and the estimated inventory as much? No. So we credit estimated inventory returns. And it's 600 or 1.7 million times the 110,000 seeds they returned. So 38824. Okay, does that kind of make sense? These last two, it takes a while. So again, all we're doing is we're setting up a refund liability for a significant amount of right to return. So, and this is based on the contract, because part of your contract is letting them return X percent or whatever, or till 4 months or whatever. So first we set up the sale. We can't just put AR in sales because that would be overstating our sales. So we include refund liability to show in our books, oh yeah, although sales might not happen, they all have 4 months to return. So it wouldn't be proper. So we split those and we leave our AR. Then we've got to record our cost of goods sold. The inventory all leaves, but cost of goods sold is kind of matched. It's 80% just like the sales. The rest go into an estimated inventory returns. They're both debits, whether on the balance sheet or on the income statement. Now when they finally come back to refund, we credit their AR and debit the refund liability because it's not a liability out there anymore. And we take our inventory and credit estimated inventory returns. And of course, if it's damaged, you'd be debiting some kind of expense of damaged goods. Okay, so I hope that made sense. I'm going to pause the video and then we'll go on to back to example, go through that. Okay, see you guys.